Heinz, as you can see, are down by 3%. They've been down all day after the condiment and packaged food maker missed fourth quarter revenue expectations in its most recent results. Lunchables and packaged meat were among the sources of weakness. This is the fourth straight quarter of missed revenue for Kraft Heinz as the company struggles with increased prices for products and consumers deal with inflation at the grocery store. For a closer look, we're joined by Erin Lash, Director of Consumer Equity Research at Morningstar. Erin, thanks a lot for joining us. I've read your note on these numbers. You think the company has several challenges facing it, and you think the challenges are real. Let's go through those challenges.
Yeah, there's a host of challenges, and they're not unique to Kraft Heinz necessarily. These are challenges that are facing packaged food firms quite broadly. Obviously, there is a focus among consumers in terms of healthier products. We've seen that in terms of the rise and a growing adoption of GLP-1 drugs. There's obviously potential challenges that could emerge depending on what changes the new administration in the U.S. opts to pursue. And then also, obviously, as you alluded to in your opening, there are selling to a cash-constrained consumer, one that is looking for value and is looking to stretch their dollars as far as they can. So there is a host of challenges facing Kraft Heinz.
What are those consumers doing who want to stretch their dollars? Are they buying private label condiments, or are they buying less processed food?
I think it's a combination. We're seeing some consumers that are feeling financial strain, shopping in more value type channels to look to stretch their dollar. There are others that are looking to buy more in bulk and lower the unit price that they're paying for the fare thereafter. In terms of the what specific decisions firms or consumers are making as it relates to private label and trading down or out, I think that's very specific in terms of the category. What we have seen is that firms that are investing behind consumer valued innovation are tending to win out. While we've talked about the challenges facing Kraft Heinz, there are a number of brands that have been doing quite well. Kraft Heinz pointed today to the Heinz brand. They pointed to the Philadelphia cream cheese brand. They also pointed to Taco Bell. So brands that they have been investing in that are resonating with consumers. The challenges from a brand perspective really reside within Lunchables, Capri Sun, mayonnaise, and mac and cheese. And so those are clearly within focus for the firm in terms of investments that are necessary, whether that's in terms of flavor profiles, pack sizes, distribution, and the like.
You used the phrase, I believe, consumer valued innovation being successfully deployed by other companies. What is that?
So consumer valued innovation can take a number of different forms, right? It can be a smaller pack size. It can be a pack that's easier to open. It can be a more appealing flavor profile. There's a host of factors that go into that. But if it aligns with evolving trends, odds are that consumers are more apt to pay up for that particular product, even if there is a private label alternative. And they're likely to stay within a particular brand family versus trading down or out.
The company points to continued shifts in consumer behavior due to economic uncertainty, and you've addressed that very completely. It also points to a decline in its U.S. away from home business, and that, as I understand it, is commercial sales to restaurants and perhaps catering companies, non-consumer sales. Mm-hmm. How important a part of the Kraft Heinz business is that?
That has been a growing piece of their business in terms of, obviously U.S. retail is still where they derive the bulk of their sales. But they have been looking to expand, not only though among restaurants, but also other away from food and away from home alternatives. So think baseball stadiums, think hotels, think, maybe movie theaters, things of that nature, healthcare and educational facilities. So those are also avenues that they're pursuing to drive growth in the away from home channel. They cited contracts that have recently been signed with the Chicago Cubs, with Hilton Hotels as being two of those that they have pursued more recently from a new customer wins perspective to drive that business. And what that business really affords is insights in terms of consumer trends from a new product perspective that can obviously feed into that retail business and the products that they're ultimately bringing to shelf.
I'm going to squeeze in one more question. You've got a fair value estimate here, and you can tell me whether that's the same thing as a analyst price target. But you've got a fair value estimate of $56 per share. That's almost double where the stock is right now. Do you believe this the company needs to execute better to get the stock up to that level, or do you think that that investors will at some point see this as a value stock and begin buying?
So there's a couple of things. Number one, our fair value is around what we think the business is worth as opposed to a price target. So what the business is worth over a multi-year horizon. We think that the market right now is reluctant to buy into their ability and the investments to pay off to yield that low single-digit organic sales growth that we expect the business to generate. We do think that they can get there, but between the discount in shares and the attractive dividend stream that the firm boasts, we do think that it is shares are quite attractive at current levels.